Hi there, welcome to the Tradescores Market Analysis for November 22nd, 2010. Before I get into this week's analysis, I just want to direct you to the track record of the stocks featured in the Tradescores Alerts newsletter product. If you go to Tradescores, log in, even if you log in as a free member, and go to the Alerts and Analysis tab, and then if you click on the Trade Tracker, which you see here, you will be able to see the closed trades. You have to click on Close there, and you can see the performance of all of the trades that I have entered and exited in the newsletter. And it's a great way to sort of see whether, number one, the stock scores methodology works, but also whether the Tradescores Alerts newsletter is worth taking. Now, if it's something that you do want to subscribe to, you can see here on the right that there is a Take a Trial Sign Up Now button. If you click on that, you will be able to start a 14-day trial. And within that 14 days, you can either cancel or choose to continue with the service. All right, let's get on to the analysis for this week. I have logged into Tradescores.com and I am in the Chart Watch area. Within the Chart Watch area, I have created a watch list of the charts that I like to look at each week. And starting us off is a chart of the Dow 30 ETF. The symbol there is DIA. You can see here a chart that is in an upward trend. We recently had the pullback, which I think spooked a lot of people out of the market, but the longer term upward trend is really intact. Although we haven't pulled back to that, we have to say that the momentum remains intact. Now, in recent days, the market has tried to break this little downward trend line, and on the Dow, it's really flirting with it. It's hard to see on this chart, but if you look to a 60-minute chart, the recent strength over the last few days has basically taken the Dow back up to that downward trend line. Now, today the market was down as much as 130 points in the morning, but came back to close, although down, it closed above the open and right at the high of the day. And that's a real sign that the buyers are trying to break that pullback trend line. The Emerging Markets ETF, symbol EEM, is very similar to the Dow, except if you look at the intraday chart of the EEM, you can see that it has actually broken its pullback downward trend line. And that happened a few days ago. So the emerging markets really have a better looking chart than the Dow, and it tells me that this market is probably going to head back up and at least test these highs, although perhaps move into new highs. So I think in the short term we should see this market move higher. Now, here's a chart of the Canadian dollar ETF, symbol FXC, and you can see that we pretty much rallied up to resistance, which is more or less par value on the Canadian versus US dollar. We've pulled back as the US dollar strengthened on those concerns in Europe, but again, like the chart of the equity markets, the Canadian dollar appears to be trying to make that bounce, and it should move back up in here, although my expectation is that it probably grinds its way sideways in the months to come. Gold also succumbed to some profit-taking last week as the US dollar strengthened, but today gold made a pretty good little rally, breaking that downward trend, and this is of course a very short-term downward trend, what we call a flag pattern. And that break of the flag, given that the trend is up, should lead to a continuation of the longer-term upward trend on gold. Here we have a chart of the Canadian Venture Composite Index. This is a good sort of proxy of the junior miners, the junior energy companies, really the junior commodity companies which tend to be listed on this market. And it's a pretty good looking chart. We had that pullback, we've broken the pullback. This may be the start of a sort of a consolidation trend where we build a little, perhaps an ascending triangle or some pattern like that in the relatively short term. But longer term, if we can break through that resistance, this market should continue higher. The chart for oil has fallen to support where it should bounce. And my expectation is that we start to move our way higher again here, unless the equity markets really break down, which would be a clue that the global economy isn't doing as well as people expect. However, given that I think the equity markets are likely to move higher, given that the US dollar is starting to move lower again, I think that the oil market should hold that support level and continue higher, although we don't really see a great strong upward trend here yet, so I would be sort of cautiously optimistic with the energy names. The chart of the NASDAQ 100 managed to break that pullback downward trend line, and again on a daily chart you don't see that level of detail, but we did manage that today, and that means that really the only market that's lagging in terms of breaking that downward trend line is the Dow, and it will probably be able to get through there given that the S&P 500 and the NASDAQ have both broken that downward trend, and they should pull the Dow higher. The S&P 500, which I think is the best index for equities, has basically risen up to long-term resistance, got stuck there. We sort of expect that to happen. We've now broken that pullback, and my expectation is that we'll kind of do this in the near term, building what is called a cup and handle pattern, and ultimately get a break through that cup and handle pattern, perhaps in December, could be in January, hard to say. But in the short term, expect some sort of sideways, quiet trading with select stocks doing well, but the overall market being generally sideways. And then if we get that breakthrough resistance, we should continue the upward trend. Here we have a chart of the Canadian market benchmark index, the TSX 60, and it is in an upward trend as well. Keep in mind here that the Canadian dollar has been doing well, and so the gains that you see here are actually better than what they appear because the Canadian dollar is stronger than the declining US dollar. Now in the last few days we've broken the pullback, and it looks like this market wants to move higher. We have already broken through long-term resistance, unlike a chart of the S&P 500. The US 20-year bond has switched from an upward trend to a downward trend. We fell probably too far away from the downward trend, which is why you get that little comeback rally, but my expectation is that this market is headed lower, and I would not be a buyer of US government bonds in the near term. Here's the all-important US dollar, which really has suffered in the last few months. It basically fell too far away from its downward trend line. I talked for a number of weeks about how the US dollar was likely to rise up to that downward trend line. It did that. It actually broke through, and that's a bit of an optimistic sign. We've broken some short-term resistance here. However, we're kind of flirting along that downward trend line. So until we get a real decisive break through it, I think the US dollar is more likely headed lower. But we are at a critical point given that it is testing that downward trend line. And my final chart this week is a chart of the VIX, which is in a downward trend. That means fear is diminishing over time. The VIX is based on the volatility in the options market, and as volatility goes down, it implies that investors are getting more confident about price. And given that this trend is down, it means that investors are growing more confident. So that is a good sign if you want a stable stock market, and we should continue to see that trend in the downward direction. Well, that has been the Tradescores Market Analysis for November 22nd. For more information on the services offered by StockScores and Tradescores, go to either www.stockscores.com or tradescores.com. Have a great week in the market and trade well.